All right, silver just delivered the most significant indicator we've seen all year, and almost everyone is missing it. Within just a matter of days, 26 tons of actual physical silver completely vanished from Shanghai's Futures Exchange. We watched the SHF stockpile plummet from 449 tons straight down to 423 tons. We're witnessing a substantial withdrawal here. This is genuine metal being removed from storage facilities. We're seeing authentic demand confronting constrained availability, and this is all unfolding precisely as precious metal values are recovering from the devastating sell-off we saw last week. I need to show you the complete situation because what's currently developing in China gives us a crystal clear view of the direction precious metals are moving. Gold reached $5,091 for each ounce earlier today. We're looking at a 9% decline from the record peak we saw last Thursday, though that itself was a fresh record high only 3 days prior to the collapse. Silver climbed past $92 an ounce, reducing what was a 41% drop from Thursday to around 24% before settling back to $87. Here's the absolutely crucial part, though. During the time Western trading venues were experiencing panic, during the time paper valuations were plummeting, during the time financial journalists were declaring we'd reached the peak, Chinese physical buying was so overwhelming that purchasing platforms and trading websites completely buckled under the traffic surge. Users were locked out. Buying was impossible. Selling couldn't happen. The entire infrastructure was swamped. This isn't what happens when a market has peaked. This is what occurs when physical buying is severing all connection with paper valuations. Before we explore what this signals for your investments, I've got to ask you something. What part of the world are you tuning in from? Leave a comment down below telling me where you are. I go through every single comment because it shows me the reach of this community. It doesn't matter if you're watching from the United States, Canada, India, Australia, the UK, Germany, or literally anywhere else on the planet. Share your location. And here's another thing. Give me your forecast for where silver's price will be when this month ends. I'm going to showcase the most interesting predictions in a future video. Everything here is completely free. There are no courses for sale, no trading signals being sold, no exclusive paid memberships. This is purely about creating a network of people who think independently and grasp what's genuinely occurring in these financial markets. So let's examine the actual figures, because data doesn't mislead us. The Shanghai Futures Exchange recently published numbers showing physical silver reserves fell from 449.65 tons down to 423.24 tons. We're talking about more than 26 tons disappearing in an incredibly brief time frame. To put this in perspective, the SHFE functions as the measurement tool for China's appetite for physical precious metals. When reserves decrease this rapidly, it demonstrates that removals are outpacing new deposits. Metal is exiting faster than it's entering. Legitimate purchasers are claiming actual delivery. The transformation from paper contracts to physical possession is gaining momentum. We're not looking at speculative contract positioning here. This isn't about futures market participants adjusting their holdings. This represents genuine metal departing genuine storage vaults, and the timing coincides exactly with silver's paper market crash. Put the pieces together. Paper valuations collapse while physical stockpiles evaporate. Shanghai price markups skyrocket while COMEX and London valuations tank. Somebody is exploiting the paper market breakdown to stockpile physical metal at reduced valuations. And it's definitely not Western retail buyers. We're seeing institutional players and industrial purchasers from China making these moves. Check out the Shanghai markup figures that should grab everyone's focus. During Wednesday afternoon's benchmark pricing sessions on the Shanghai Gold Exchange, gold settled at a level equivalent to $43 per ounce over London's quoted prices. A $43 markup. Physical gold in Shanghai is exchanging hands almost 1% higher than paper gold in London. When it comes to silver, the markup went beyond $13 per ounce. Physical silver is changing hands approximately 15% above paper valuations. I'm going to say this again for emphasis. Physical silver in China is commanding a 15% premium compared to paper silver in London and New York. If paper prices reflected true value, what possible reason would anyone have to pay 15% extra? There wouldn't be one. unless they're aware the paper price is being artificially held down. Now, this next part gets even more compelling. China's gold-supported ETFs experienced unprecedented withdrawals totaling almost $1 billion this past Tuesday. $1 billion in 24 hours. Following more than $7 billion in deposits throughout January by itself, we suddenly see $1 billion exit. What conclusion can we draw? Sophisticated investors aren't dumping gold. Sophisticated investors are transforming paper gold holdings into physical gold ownership. They're liquidating ETF positions and accepting delivery of tangible metal. This explains the premium explosion. This explains the SHF inventory depletion. This explains why purchasing platforms collapsed. China's Securities Times published reports indicating numerous institutions feel last week's decline hasn't undermined the medium to long-range fundamentals supporting gold. They point to deteriorating dollar reliability, worldwide central bank gold acquisitions, and geopolitical circumstances as justification for gold's continued investment appeal. We're seeing China's mainstream financial press conveying what their institutions actually think. The dollar is becoming less trustworthy. Central banks keep accumulating gold. Geopolitical stress keeps intensifying, and gold represents the solution. Here's something that occurred during the crash that nearly everyone overlooked. Shanghai's gold price, denominated in yuan, plunged 19% between Thursday and Monday. That represents a savage pullback, regardless of how you measure it. But pay attention to this critical detail. It's already bounced back 12.5% from the bottom. The Shanghai benchmark settled at 1,138 yuan for each gram. China's CSI 300 equity index fell 3.1% over the identical timeframe and has merely recovered two-thirds of that decline. Chinese gold is rebounding more vigorously than equities. Physical metal buyers are entering positions more forcefully than stock market participants. That reveals where genuine confidence resides. Speaking about confidence, let me share what Shanghai Futures just accomplished. We're talking about a proprietary trading firm controlled by Chinese businessman Bian Shiming. Based on Financial Times reporting, Shanghai generated more than $500 million profiting from silver's price collapse by wagering against last week's price explosion on Shanghai's Futures Exchange. $500 million. They anticipated the parabolic trajectory. They took the opposite position and captured profits when everything crashed. This isn't a case of some individual trader hitting the jackpot. This represents a highly sophisticated trading enterprise. What does this reveal? It shows us that intelligent capital in China anticipates these price movements. They comprehend how paper market structures function. They recognize when excessive leverage builds up, and they capture gains from the turbulence while building physical positions during price drops. The volatility doesn't frighten them. They're manufacturing profits from the chaos. Shanghai's Futures Exchange reacted to this turbulence by increasing margin obligations for both protective hedging accounts and pure speculation accounts in silver. The Shanghai Gold Exchange modified both margin obligations and maximum daily price fluctuation parameters for gold and silver. They're attempting to reduce the speculative frenzy. They're working to decrease system leverage. But here's what increased margin obligations actually accomplish. It eliminates weak position holders. It liquidates excessively leveraged accounts. And it moves metal from paper contract traders to physical metal owners. Each margin call represents a transfer of wealth from speculators toward accumulators. Let me bring up the human side of this story. Chinese news outlets interviewed a real estate professional who recently purchased gold. According to him, a banking contact mentioned gold markets were performing excellently and returns could hit 20%. He admitted he was simply riding the momentum and experimenting. Then, he expressed surprise at becoming trapped immediately after purchasing. This illustrates the harsh reality of speculative market timing. When you purchase at peak prices using borrowed capital, you'll panic and liquidate at the absolute worst moment. However, when you comprehend your purchase and your rationale behind it, price corrections become chances for gain rather than catastrophes. Fast question for everyone here. How many of you currently possess physical gold or silver that you can actually touch? I'm not asking about paper ETFs or shares in mining operations. I mean real metal you physically control. Leave a comment and share with me. Let me break down why the SHFE inventory decline carries such weight for worldwide silver valuations. The Shanghai Futures Exchange operates as the measuring instrument for genuine physical appetite across Asia. Declining inventories signal that metal withdrawals are surpassing new metal additions. Greater quantities are being requested than what's being provided. For silver specifically, this stems from manufacturing consumption combined with investment appetite. Solar panel manufacturing by itself devours massive silver quantities. This represents foundational demand. It doesn't evaporate when paper valuations crash. Recent SHFE figures show reserves decreased from 449.65 tons to 423.24 tons. Reduced inventory volumes intensify competition for immediate delivery metal. Competition drives markups upward. Elevated markups reinforce stronger futures valuations. This establishes a reinforcing cycle that ultimately compels paper prices upward to align with physical market conditions. Worldwide physical silver availability confronts mounting strain. Production expansion from mining operations stays limited. Metal recovery through recycling struggles to expand. These elements restrict the market's capacity to address abrupt demand surges. Declining SHFE silver reserves indicate the international supply infrastructure can't satisfy Chinese appetite. You might be questioning why there's such heavy emphasis on China. China's silver marketplace occupies a pivotal position in determining worldwide market behavior. When Chinese reserves contract, international markets feel the consequences. Every additional gigawatt of solar generation requires substantial silver content. As sustainable energy implementation accelerates internationally, fundamental silver requirements continue ascending. Paper trading venues can restrain valuations for limited periods. They can't manufacture physical metal that simply doesn't exist. Now, regarding the gold situation, the ETF movement patterns expose something intriguing. Chinese gold ETFs absorbed more than $7 billion throughout January. Then, almost $1 billion departed within one trading session following the crash. The logical interpretation suggests investors converted ETF holdings to obtain physical metal ownership. The appetite didn't vanish. It shifted from paper form to physical form. For investors in Western markets, if you're exclusively monitoring COMEX valuations and London benchmark pricing, you're observing an incomplete picture. You're witnessing the paper performance while physical market reality unfolds in Shanghai. A $43 gold markup isn't standard market behavior. A $13 silver markup isn't standard market behavior. A 26-ton inventory withdrawal isn't standard market behavior. These represent indicators of a market undergoing fundamental change. For active traders, the price swings we've witnessed are extraordinary. Silver plummeted 41% from its zenith to its nadir. Gold pulled back 9%. These represent movements that eliminate leveraged accounts. Margin increases compel traders to inject additional capital or shut down positions. Most lack the ability to inject capital with sufficient speed, so they liquidate and valuations drop even further. This generates sequential forced liquidations disconnected from underlying worth. If you're an investor concentrating on physical metal accumulation, this turbulence works in your favor. Every crash becomes a markdown. Every suppression becomes a chance. Here are 3 critical price points I'm monitoring for silver currently. We plunged from above 120 down to 87. The 90 to 95 area remains active. Should 87 maintain as foundational support, we might witness movement back toward 100. Should 87 fail, the subsequent significant support zone exists around 78 to 80. Regarding gold, the 4,900 to 5,000 territory represents the crucial contested area. Physical purchasers paying substantial markups are casting votes with actual capital. Mining company shares can deliver superior returns compared to physical metal during bullish periods, though they introduce hazards that physical metal completely avoids. Executive team risk, geographic political risk, expense inflation, regulatory approval obstacles, share dilution. Physical metal under your direct control eliminates counterparty exposure. What matters is comprehending your holdings and your ownership rationale. Let me return to the broader economic landscape. International central banking institutions are purchasing gold at unprecedented volumes. They're spreading reserve holdings across multiple assets. Geopolitical stress and monetary system vulnerabilities are motivating this conduct. Silver occupies a distinctive status, functioning as both a monetary asset and manufacturing input. Solar technology, electric transportation, consumer electronics, and healthcare equipment all demand silver. Appetite is expanding. Availability is restricted. Stockpiles are depleting. I want your perspective in the comments section. What's your silver price forecast for when this year concludes? Do you believe we'll challenge previous record highs beyond 120? Do you anticipate fresh records exceeding 150? Or do you think paper market forces will keep valuations suppressed? Share your reasoning with me. Before I conclude, here are 3 essential points to remember. Point 1. SHFE silver reserves fell by 26 tons. This represents physical metal departing storage and genuine demand surpassing available supply. Point 2. Shanghai markups for both gold and silver demonstrate physical metal exchanging considerably above paper valuations. Point 3. ETF withdrawals most likely indicate transformation from paper to physical ownership rather than metal abandonment. Conduct your own investigation and analysis. Comprehend the exposure you're taking on. If you're operating with borrowed capital and leverage, this turbulence has the potential to wipe you out completely. If you're building physical positions and grasp the foundational argument, this might represent a substantial extended duration opportunity. The future will provide the answer,